Welcome back. So this is the first video for Chapter 14 in Intermediate Macroeconomics, and Chapter 14 is the first chapter of the sort of extensions in the book. So the first 13 chapters were about building up our models for the short run, where we had the ISLM model, the medium run, where we had added the Phillips curve using the wage setting and price setting expectations model, and then the long run, where we talked about long run growth. Chapters 14, 15, and 16 are all about expectations and the role that expectations play in the macroeconomy. And then chapters 17 through 20 are all about an open economy. So an economy where we have both the flow of goods and services with exports and imports, but also the flow of financials, right? And so we have to think about the flow of currency and bonds and etc. So in Chapter 14, the first thing we're going to talk about is the role that expectations play in the financial markets. So we're going to look first at bond prices, where interest rates are integral, right? A bond is a loan, and so the important part of the loan is, the interest rate and when you're going to get paid back in terms of how much you would pay for that bond. Then we will talk about stocks. We'll also talk a little bit about other asset prices like houses. We want to talk about expectations in a more formal way because expectations really play an important role in economics, right? We've talked about that a little bit already when we talked about, when we thinking about, what might be the causes and consequences of recessions. Now we're going to do it with a little bit more math, but nothing too bad. It's something that everybody should be able to do. So we want to think about, when we're thinking about the future, we want to think about the value of an expected flow of payments in the future, right? So what is the value today of an expected flow of payments? And so one way would obviously just be to sort of add up the flow, right? If I'm going to get $10 today and $10 next year and $10 the year after, maybe it's just $30. But actually we need to think about the different value of those $10 now and in the future, thinking about interest rates and to some extent inflation in order to calculate the expected present discounted value. And so the idea is that $1 today is worth more than $1 in a year, because if you took that dollar and put it into your bank account or bought a bond with it, you would have $1 plus the interest in a year. Similarly, that $1 in a year is worth less than $1 today, because you could take less than that and put it into an interest-bearing account and have $1 next year. So we're going to talk about how to calculate those expected present discounted values, and then we're going to apply it both to the bond market and then to the stock market as well. So the question is, all right, well, what do we use as the discount factor? And actually, there's no one right answer in terms of what we would use. We're going to focus on, we're going to use the interest rate. We're going to call it IT, right, the discount rate. But that might not be true, right? It might actually be higher than the interest rate, especially for someone who is very focused on the present, right? So if they have a present bias, and based on psychological research, almost all human beings do have a present bias, then it might be higher than the interest rate. So 1 over 1 plus IT is called the discount factor. And we'll see that that's going to be important because we need to discount future payments by the discount factor in order to get its present value. And so what this means is that as the interest rates go up, that means it's going to lower the value of the future payments in the present. So that will reduce the present discounted value. So let's think about this. Let's do 3 examples. So we have, this is a nice little chart here where we have this year, we have next year, and then we have 2 years from now. So if we take $1 and we put it into an interest-bearing account, or we buy a bond with it, then next year we'll have $1 plus the interest rate, right? And if we had $100, we would have 100 times 1 plus the interest rate. Similarly, if we wanted to think about, well, what's the value of $1 next year today? Well, then we have to reduce it by that discounted value, right? Because we could take some amount less than $1, put it into that savings account or that bond, and have $1 next year. And so in this case, we divide by 1 plus IT, right? That's what we call the discount factor, that 1 over 1 plus IT. Similarly, if we want to think about what's going on in 2 years, if we take $1, then we would have 1 plus IT next year, and then we put that, we just keep holding that in the bond or the savings account. We'd have that times 1 plus IT plus 1, which is the interest rate in a year. So in that case, if we wanted to think about, well, what's the value of $1 in 2 years? Well, we would take 1, we would divide it by 1 plus IT times 1 plus IT plus 1. So one thing to keep in mind is, and then we'll talk about this a little bit at the end of this video, is sort of thinking about nominal versus real. And so as long as you're comparing dollars, right? If you're comparing dollars this year, dollars next year, dollars in 2 years, then it's perfectly fine to use the nominal interest rate because you're comparing dollars in each period. But as soon as you're comparing anything that's real, right? And so then you would just replace the IT with RT, RT plus 1. And then obviously you have to think about, well, we don't know what inflation is going to be, so we would have to take the expected real interest rate based on the expected rate of inflation. Okay, so this looks really complicated. It's not that complicated, and we're not going to worry too much about the math on this page. We're just using it to get to the math on the next page, which is very simple. So let's imagine that we are going to get Z dollars this year. We're going to get some expected amount, ZE dollars, in the future. So we'll get ZE T plus 1 in a year, ZE T plus 2 in 2 years, etc. ZE T plus 3 in 3 years. And we want to figure out, well, how much am I willing to pay now in order to get that stream of payments, right? So what this $ VT is the expected present discounted value of getting all of these payments. So this year we get ZT. We know what it is. It's not expected. We don't need to discount it because we're getting it right now. But next year we have this expected value. And since it's in the future, we need to discount it by the discount factor, so it's 1 over 1 plus IT. And then in 2 years, we have this expected value, ZET plus 2, and we have to discount it by the discount factor for 2 years, right? So 1 over 1 plus IT times 1 over 1 plus ITE plus 1. And the nice thing is that as long as we have constant interest rates, right, then this just becomes, in the second year, it becomes 1 plus I squared, and then the third year, it would be 1 plus I cubed. So that's pretty simple. And then if we have constant payments, right, which a lot of bonds do, they'll have like regular coupon payments every quarter or every year, so that the $Z is the same, then we can factor that out. Right, and so now our present discounted value, $V sub t, is equal to just $Z, that's what you're getting every year, times 1 plus 1 over 1 plus I, plus 1 over 1 plus I squared, plus etc., times 1 over 1 plus I to the n minus 1, right? Assuming n is the number of years where we get the payments. And it's n minus 1 just because we have, we're counting the first payment as a year. So the nice thing is that this actually has a neat solution where as long as the interest rates are constant, which we don't really know, but we can make an assumption, and the payments are constant, and if n goes on forever, then the present discounted value is just the coupon payments, the $Z, whatever you're getting each year, divided by the interest rate. Obviously, if the interest rate is 0, then that would just be the sum of Z, right? And the sum of Z forever is going to be infinite. And so, if you don't discount the future at all, you'd be willing to pay an infinite amount for an infinite stream. Of course, that doesn't make sense from a human point of view because we die. So we don't last forever. If we want to think about real payments, right, then we just need to think about the real interest rates. And unfortunately, we can make an assumption that the real interest rate is going to be the same forever, but we don't really know that. And we know from history, of course, that inflation does change over time. And so you would really want to think about that as well. So We can either do it in terms of all dollars, and usually that's what people do, because as long as you're comparing dollars and dollars and you know the nominal interest rates, especially like in a bond where the nominal interest rates are spelled out, and you know the dollar payments are spelled out, then that's fine, right? So as long as you have dollars on both sides, you're good. But if you have payments expressed in real terms, then you have to discount using real interest rates, right? So if the payment Z is in real terms, like, I mean, it could be, right? It could be like, I'll give you a bag of potatoes every year. Well, then now you have to think about real interest rates, because you have to think about inflation and expected inflation. All right, so that is our first sort of introduction to expectations and present discounted values. Now, first, we're going to then talk about the bond markets, and then the stock markets, and then other asset markets as well.